Hello everyone, I'm Niranjan Goyal, CACS and MBA. Now today discussing capital gains provision and some very useful tax planning tips. Capital gains, it comes from sale of capital asset. We check the asset class and period of holding to determine the tax rate. The tax rate, when applied on the gain, we get the tax liability. And there are certain exemptions and certain deductions which are available, which we will discuss in the subsequent slides. So capital asset. Capital asset means assets which are defined in the Act like properties, securities, or any archaeological collection, painting, drawings, sculpture, work of art. So these are the capital asset which are considered for taxation. Capital asset doesn't include any stock in trade, any personal effects like your movable car, furnitures, or agricultural land in rural area. When these capital assets are transferred, then only capital gain comes. So transfer is defined as sale, exchange, relinquishment of assets, or extinguishment of rights therein. However, there are certain transfers which are not considered as capital gain, like gifting on will, or irrevocable trust. Similarly, in the case of mortgage, reverse mortgage, distribution of asset in the case of partition of HUF, or distribution of asset in the case of liquidation of companies. A period of holding is a very important concept to determine the rate of tax. So in the case of listed equity shares and equity-oriented mutual funds or listed debentures, it is 12 months on which 15% of tax rate is applicable in the case of short-term capital gain, and in the case of long-term capital gain, only 10% taxation is applicable. However, there is no indexation applied in the case of long-term capital gain. Similarly, in the case of unlisted equity shares or immovable property, the asset has to be held for 24 months. The tax rates are applicable based on the assessee's tax rate slab, whereas in the case of long-term capital gain, it is applied at the rate of 20% with indexation. So we'll cover one example to discuss this point. And in the case of other assets, these are to be held for a period of 36 months, and the rate of tax in the case of short-term capital gain is what is applicable to the assessee, whereas in the case of long-term capital gain, it is 20%. So what happens to the short-term and long-term capital gains if there is a loss, if it has to be carried forward? Those discussions we will do here. So in the case of unlisted shares, land and building, it has to be held for 2 years. Otherwise, like, it will be treated as a short-term capital gain. And in the case of other asset, it has to be held for a period of more than 3 years. Indexation is applied only on long-term capital gain. Tax rate applicable is flat 20% in the case of long-term capital gain, whereas in the case of short-term capital gain, whatever is the tax rate of the assessee, that is applicable here. Basic exemption limit is applicable in both the cases. Exemption under section 54 is applicable only in the case of long-term capital assets. We will discuss this section 54 in subsequent slides. Deduction on account of brokerage and other charges are allowed here to determine the net sale consideration. Securities transaction charges are not allowed. Loss, if any, happens in the same year can be adjusted in the case of, say, short-term sale of asset. Then it has to be adjusted only against short-term capital gain or long-term capital gain, whereas in the case of long-term capital asset, it has to be adjusted only in the case of long-term capital gain here. If suppose there are still losses which cannot be set off, these has to be carried forward for next 8 years. And deductions under section 80C to 80U, generally that 1.5 lakh rupees what we discussed, these all are applicable in the case of short-term capital gain, but these are not applicable in the case of long-term capital gain because that's a flat rate structure. We'll take an example. Say we are selling a immovable property which we purchased in say August 2018 for 60 lakh. Now we are selling in August 2023 at double the price, which is 1 crore 20 lakh. So there is a direct gain of 60 lakh rupees. However, since there is a cost of sale like brokerage and other things that get deducted, so the actual net consideration considered here is 1 crore 80 lakh. From there, we deduct index cost of acquisition, not the actual cost of acquisition. Actual cost of acquisition in this case was 60 lakh, whereas index cost of acquisition, which is 24% more than the actual cost of acquisition, is 74.57 lakh. That we deduct here to ascertain the actual long-term capital gain, which is 43.42 lakh. If no exemption is taken, then there is a tax of flat 20% and whatever surcharge is applicable. However, it can go up to maximum 15%. Then we get a total tax liability of 10.38 lakh, which essentially comes to the effective tax rate is 23.9%. So in this case, what we see is the indexation has reduced the capital gain and thereby the overall tax liability. We now move on to the listed equities or debentures which are listed, as well as some of the units of mutual fund which are listed in the stock exchange. So in these cases, the period of holding is considered as 1 year. If it is held more than 1 year, it is treated as long term. Tax rate for short term capital gain is 15%, and in the case of long term capital gain, it is 10%. There is a special exemption which is available for on the sale of long term equities or mutual fund, which is 1 lakh rupees flat every year. So we'll discuss on the tax planning point on this part. Basic exemption slab limit is applicable in both the cases, short term as well as long term. Brokerage and other charges are also deductible. As we discussed earlier, securities transaction charges are not deductible. Loss in the same year can be set off against short-term capital gain and long-term capital gain in the case of short-term sale of asset, and in the case of long-term sale of asset, it can be adjusted only against long-term capital gains. Carried forward is allowed for 8 years. If there is a losses, then that can be carried forward for 8 years. Deduction under both the sections are not allowed because these are again flat rate structure, and surcharge, as we discussed, is maximum 15%. So we'll take an example here. It's a very interesting example. Suppose somebody has purchased 5,000 shares of Reliance Industries. We are taking Reliance, just it's one of the leading stock. There is no recommendation for purchase, but we can take this for example purpose. Suppose it was purchased for 60 lakh rupees in 2018, and now the sale price is 1 crore 30 lakh rupees, and say there is a brokerage charge of 40,000. The actual net sales consideration is 1 crore 29 lakh 60,000. From there, we get a 69 lakh 60,000 rupees of gain. If we apply 1 lakh rupees exemption limit, the actual taxable gain is 68 lakh 60,000. Moving on to the exemption and tax planning tips. These are very, very important and useful tips for you. So under section 54 and 54F, if someone sells a residential house property under section 54 or any property in the case of section 54F, then and there is a long-term capital gain, on that tax can be reduced to nil also if another house property is purchased within next 1 year, within next 2 years, or constructed within next 3 years. However, if in past 1 year also something has been purchased, that will also be considered for the purpose of this exemption. However, in case there is a delay, the money earned from the sale of previous asset can be parked in capital gains. This budget 23, government has put a ceiling of 10 crore on the long-term capital gain exemptions under section 54 and 54F. Similarly, section 54B covers sale of urban agricultural land, and any purchase of urban or rural agricultural land in next 2 years is allowed as a exemption for the purpose of taxation. However, in the case of section 54EC, any taxpayer any long-term capital asset can be transferred, and the gain made on that can be saved up to rupees 50 lakh rupees by investing that up to 50 lakh rupees amount into bonds notified by government like NHAI, REC, and so on. The investment has to be done within 6 months in those bonds, and of course those bonds has a lock-in period of 5 years. In those 5 years, money should not be withdrawn, or even loans cannot be taken against the security of those bonds. So very important point as a tax saving. These are just quick points on the capital gain scheme. So under capital gain scheme account, anyone can park the money up to the filing of return. However, in the case of bonds, within 6 months from the date of transfer, this investment has to be done. So there are very important useful tips. Tax harvesting means 1 lakh rupees of long-term exemption on equity shares which are listed, or mutual funds which are listed. Those can be realized every year. So in spite of taking profits in one particular year, we should take it in multiple years by 1 lakh rupees each. By that we pay no taxes at all. Loss harvesting. Suppose if there is a gain in a particular year, and we can set off that against losses. And in our portfolio, if there is a losses, we should book that loss in that year, and we end up in paying low or no taxes depending on how much is the net gain. We will take an example, like if say short-term capital gain from sale of company A share is 2 lakh, short-term losses in the case of shares of company B is 1 lakh. So net short-term taxable income will be only 1 lakh. So this 1 lakh loss has to be booked. Any carried forward losses can be used for the purpose of adjustment in the current year profit, and thereby we can reduce the tax liability to almost nil. There are a couple of other points which we should consider, like convert short-term gains to long-term gains. If suppose the date of transaction is like that, in next 10 days, say we hold that transaction and it becomes long-term, we should push out that by those couple of days so that we take the advantage of long-term, be it a low tax rate or indexation benefit. Similarly, in the case of indexation benefit, every year new indexation rates are published. So, and those are generally 4 to 5% higher than previous year. So your cost of purchase will go up by that 4 to 5%. We should try to push out that particular transaction to next financial year so that we take additional benefit of indexation. Choosing right or appropriate asset class, like investment in say mutual fund with 65% equities are considered as a equity oriented mutual fund. So though they have like a debt component, they will still be treated as a equity, and we get all the advantage of listed equity mutual funds. And don't forget that we need to pay advance taxes in the quarter in which we make the gains, else there will be interest on that. So always pay advance tax as soon as the profits are realized. And since there is a discussion about shares and stocks, we can't leave aside the futures and options. However, futures and options, including intraday, is considered as a business income. It's not a capital gain, it's a business income, and is a non-speculative business income. So any expense like salaries, rent, subscription, interest, all those things are allowed as deduction, like typically it's allowed in the case of a business. That it is taxed at the slab rate applicable to the taxpayer. Loss in the same year can be set off against other heads of income also, except speculative income and salary income. If there is a carry forward, this carry forward can be done for next 8 assessment year and can be adjusted against profits and gains of business only. However, in the case of intraday trading, buying in the morning, selling in the evening, or like first selling and then buying, which is short selling, these all are considered as a speculative. And speculative business income can be set off against the losses in speculative business income can be set off against income of speculative business only. And in the case of carry forward, only 4 years is allowed. In the case of losses set off, and tax. These are tax at the slab rates applicable to the taxpayer. If you like the video, please like it, subscribe it, share it, and to get future such useful videos, click the bell button. Thank you. Thank you everyone.